you have seen a glimpse of what this strategy is capable of, and this strategy was given to us by ICT in his 2022 YouTube mentorship, which I have gone through all of the videos, 41 of them, and I have made this strategy mine, and this is the model that I'm about to share with you guys today. If you stick with me in this video till the end, I promise I'm going to break this strategy down into 7 easy steps, which if you follow them, you're going to find a setup with this strategy every single week on the pair which we are going to be trading, which is NAS 100, that is an index, or you can trade it on the NAS futures. So right in front of us here right now, you can see the trading plan checklist, which is what we are going to be looking at. As you can see, it's 7 different steps. And step 1, draw a vertical line at 8:30 and 11 New York time on the 15-minute time frame. Then the next thing we do, that is step 2, we draw a horizontal line on the swing high and low nearest to price. The 8:15 candle that forms, that is very close to the vertical line that we have drawn, we look for a swing high above or a swing low below, and we draw a horizontal line. Then we go to step 3. When the high or the low is broken, start looking for a trade on the 1 minute. So we are still on the 15-minute time frame. That horizontal line which we just drew, that is in step 2, we wait for it to be broken. So we wait for price to either go above it or below it. And when price does that, that is when we are going to leave the 15-minute time frame. We drop down to the 1 minute time frame and we start looking for a trade setup. What do we look for? Now, that is where we go to step 4. We wait for an impulsive move that takes out a low or a high. This could be in any case. That is, maybe if it's a break in market structure where maybe the price was going down, then price starts going up. We wait for that impulsive move. Or maybe price had been going down and there was a low it formed and price broke that low. Then we go to step 5. Draw out the fair value gap that formed and wait for price to return. When this impulsive move has happened with very strong candles, definitely there's going to be a gap between, and that gap is what we call a fair value gap. When that happens, we use our rectangle and we draw out that fair value gap, and we are waiting for price to return to it. So now that is when we place a limit order at that fair value gap, and we place the stop loss above. That is if we are taking a sell, and we place it below. That is if we are taking a buy. Then now, for take profits, he said in the videos that we are looking for a high or a low that we know price is going to be drawn towards. That is for liquidity. I don't want to speculate that way, and I want to make it very easy for each and every one of us. And that is why I'm putting it the Fibonacci. So I want us to target the negative 0.5 level on the Fibonacci. I'm going to demonstrate that to you, and that is what we are going to be looking for. I want to make it as simple as possible and mechanical, so it's something that every person can follow. So now let's get into the chart so we can see what we are talking about. Right in front of us right now is the NASDAQ 100 index, and this is the chart, the only pair that we are going to be using for this strategy. So on the 15-minute time frame, that is where we start, and that is where we start following our checklist. Rule 1 on our checklist says we should draw a vertical line at 8:30 and 11 New York Standard Time. So unfortunately, my chart right now is in GMT, but no problem, because I'm still going to follow the 8:30 and 11 New York Standard Time. So on this time, it's going to be 12:30. That is going to be 8:30, and then it's going to be 15. 15 is going to be 11. Step 1 is done. Then we go to step 2. We draw a horizontal line on the swing high and the low that is nearest to price. So as you can see, this is the candle that forms before the 8:30 candle, right? This is the 8:15 candle. Now, which swing high is just above price? I want to believe you said this one. This is the swing high. And what is a swing high? A swing high is a high that is formed, then to the left of it is a lower high, to the right of it is another lower high. We are looking for just the nearest swing high to price. So what do we do at this point? When we see that swing high, we draw a horizontal line on that swing high, that is to price. So that is what we do. We do that. Then now, on the lower side, we look for a swing low. And what is a swing low? Just the opposite of a swing high, right? To the left of it, we have a higher low, and to the right of it, we have another higher low. So I want to believe you said this one. This is the nearest swing low to price. So we do the same thing like we did for the high. So we draw it over time. And now, when we have done this, now we go to step 3. So what does step 3 say? When the high or low is broken, we start looking for a trade on the 1 minute time frame. We are just going to continue forwarding price, and we are going to wait for either the high or the low to be broken. There we go. The high has been broken. When the high is broken, what do? We have to drop now to the 1 minute time frame, and that is where we start looking for our trading setup that we are going to take. So right now we are on the 1 minute time frame, and on the 1 minute time frame, what do we start looking for? Wait for an impulsive move that takes out a low or a high, and we already know what a swing low and a swing high is, so that is what we are going to be looking at. Maybe somebody could say right here is maybe an impulsive move, right? But now, does this impulsive move take out any swing low or any swing high? No, it does not. So according to us, that is not even something we are going to be looking at. So until we see an impulsive move that has actually taken out a swing low or a swing high, then that is when we are going to be interested in it. Somebody could say this is probably an impulsive move that maybe took out the swing low right here. But now, according to me, based on what I've seen in the market consistently, now we are looking for sales, right? So I want to see 2 consecutive bullish candles before the impulsive move, and you're going to see why I need to see that. 9 out of 10 times, that impulsive move is going to fail if it does not have 2 bullish candles before the impulsive move. So we continue searching. If we had taken this as an impulsive move, what would have happened? So you see, price actually would have taken us out. This looks like an impulsive move, right? Everybody will be like, oh, this is the impulsive move that we are looking for. And there we go. That's the fair value gap that we are probably looking for. But just like I said before, I want to see 2 bullish candles that lead to that impulsive move. That is a very crucial point to this strategy. That is what you should also note down when you're looking for it. And you're going to see why we look for that. Because if we took this trade, you're going to probably see what can happen at the end of the day. So as you can see, if we took this trade, we would have been tagged in here, right? And let's say maybe this is TP1, or maybe we are looking for these lows. There we go. If we had taken this trade for a sell, we should have been tagged out right here. This was not a valid trade for us because we did not see 2 consecutive bullish candles before the impulsive move. Then now on the flip side, we now see another bullish impulsive move here, right? But now when this bullish impulsive move happens, as we said in our row, we want to see it taking out a high or a low. So until this bullish move has actually taken out this high, this is not an impulsive move that we are looking forward to. Okay, there we go. So you see, it did not take out that high. On the other side, we see that another impulsive move has happened, which has taken out this low. And we see right here, price has formed a fair value gap. This could be a possible place where we would have taken a trade. But now you can see there is a fair value gap at the top, and there's another fair value gap at the bottom. Just as ICT says, when there are 2 consecutive fair value gaps that have formed in price, what do? We don't take the trade at the first one, because 9 out of 10 times, price will come to the second one that was formed and probably not get to the first one. So what we do is we probably take a trade at the second one, then we anticipate that price might get to the first one. We will probably just draw out the first zone. This is the first zone of the fair value gap. Then this is the second zone of the fair value gap. And then we just wait. That is what our strategy says. After the impulsive move happens, now that is step 5, right? We draw out the fair value gap that has been formed and we wait for price to return. That is what we are going to be doing right now. As you can see, price just kept on going, and price has actually formed many other fair value gaps as price has been going down. With just this happening, the fair value gaps that were formed here have actually gotten weak. So at this point, I just take out the fair value gaps because price has gone so far, price has formed other fair value gaps, and there's a likelihood that price might not come back to this one. I want to believe this is another kind of impulsive move, right, that somebody is going to look at. But still, there were no 2 consecutive bullish candles to this. So this is not a fair value gap, and we continue searching. There we go. We've seen a very good bearish impulsive move. Then the next candle forms a fair value gap. This is what we are interested in. This is what we want to see. And when this happens, what do? We draw our zone. So as you can see, price has formed two consecutive bullish candles before the zone. As you can see that clearly. Then you can see there's a fair value gap. This is what we call a fair value gap. When there's a bearish move, then another one, you can see price was not filled completely. And when this happens, now what do? I now go now to the next step, right? That is placing a limit order at the fair value gap with a stop loss above the zone. This is a bearish setup, right? So I'm going to place my stop loss above the zone. The three candles that form the fair value gap, the first one, the second one, and the third one, I place my stop loss above the first one. Then I place my entry down here. Then for my take profit, now that is where step 7 comes in. We target the negative 0.5 level of the Fibonacci. We draw the Fib from the top to the bottom. And when that happens, based on the backtesting that I've done, I've realized that most of the times, price always comes back and retests the 0.5 level of the Fibonacci. This helps me with a smaller stop loss as well as getting at least a 1:2 in almost every trade that I take. We are going to be placing our trade on the 0.5 level, placing our stop loss above the 1. Then we target now a negative 0.5 level of the Fibonacci. So let's place our trades. We have placed our trades. You can see this is our entry, this is our stop loss, and this is our take profit. So after placing the trade, now all we do is we remove the Fibonacci. Then we just watch how price plays out. So we have been tagged in our sell. There we go. This is how powerful this strategy that was given to us. And if you follow all these rules that I've given to you, lay down 7 easy steps, these are the kind of trades that you can have every single week in the market. And I'm telling you that because I have backtested and I have seen that this actually works. I hope you have loved this video and I hope I have made it as simple as possible. That is something you can go and incorporate in your own trading and see if it works for you. In the coming weeks, I'm going to make more videos and break down more setups that price have given to us like this in the future, and also show some of the flaws of this strategy, because the strategy also has its flaws where it does not work. If you love this video, please drop a like and a comment, and I'll be looking forward to see you in the next one.